What China has been doing with gold, quietly, systematically, at a scale that the Western financial press has consistently underreported, is not a theory. It is a documented institutional behavior that has been building for years, and what it reveals about the real price of gold, the price that the world's most patient and most resource-rich accumulator has been willing to pay in volume while most individual investors were watching something else, is the conversation that every serious gold and silver investor needs to have right now. In the next 10 minutes, I'm going to show you exactly what China's gold strategy exposes about where the price of this metal actually belongs, why the gap between where it trades and where it is headed is one of the most documented asymmetric opportunities in modern financial history, and exactly what you need to do about it. I want to start with a story about patience and scale, because these two qualities are at the heart of everything China's gold behavior reveals. In the early 2000s, a relatively unknown institutional investor began quietly purchasing shares in a company whose products were being dismissed by the mainstream as obsolete and too niche to matter at scale. This investor did not announce his position. He did not hold press conferences. He simply bought consistently across multiple years at prices the broader market considered too high. That investor was Warren Buffett. The asset was different, but the behavioral pattern, patient, systematic, undisclosed accumulation at prices the market had not yet validated, is identical to what China has been doing in the gold market for nearly 2 decades. The People's Bank of China, along with Chinese sovereign wealth vehicles and state-connected institutional buyers, has been accumulating physical gold at a pace that places the Chinese state among the largest gold accumulators in recorded monetary history. When a sovereign entity of China's scale accumulates an asset over many years, at steadily rising prices, without reversing regardless of short-term movements, it is expressing something its public statements never fully disclose. It is expressing a view about what that asset is genuinely worth, built not on speculation, but on the kind of multi-decade institutional analysis that most individual investors do not have access to. Let me tell you what China's gold accumulation actually exposes about the real price, because this is the insight that changes how you look at every gold price quote you will ever see again. The price of gold that appears on financial screens every day is determined primarily by trading in paper gold markets, futures contracts, exchange-traded instruments, and derivatives that allow market participants to gain exposure to gold's price without ever owning a single physical ounce. The volume of transactions in these paper markets dwarfs the volume of physical gold that actually changes hands, which means the price being quoted is set primarily by instruments that can be created in unlimited quantities, not by the supply of the actual metal itself. China, by contrast, has been buying the real thing: physical gold, delivered, vaulted, and held within Chinese sovereign control. And what China's willingness to buy that physical gold at current prices and above reveals is a view held by some of the world's most sophisticated state-level analysts that the paper price significantly understates what the physical metal is genuinely worth as a reserve asset in the world that is currently being built. This gap between what the paper market price is and what the largest physical accumulator is willing to pay in volume is the exposure the title describes. China is not predicting what gold will be worth. China is demonstrating, through documented purchasing behavior at scale, what it believes gold is already worth in terms of strategic monetary value. And the rest of the world is slowly, inevitably, beginning to close the gap between the paper price and that strategic reality. Here is what many investors are overlooking about the broader context of China's accumulation. The global monetary system built around the US dollar has been under increasing structural pressure for years. Central banks worldwide, not just China, but Russia, India, Poland, Singapore, Turkey, and dozens of others, have been reducing dollar-denominated reserves and increasing physical gold holdings at a pace the World Gold Council has documented as historically unprecedented across multiple consecutive years. This is not a marginal trend. It is a documented, sustained reallocation of the world's official monetary reserves toward the oldest, most universally recognized store of monetary value in human civilization. When sovereign institutions with planning cycles extending decades into the future collectively decide to hold more gold and less paper currency, they are expressing a view about relative value that every individual investor should take seriously. Not because central banks are always right, but because the resources available to them for analysis and the consequences they face for being wrong with sovereign wealth make their collective behavior one of the most meaningful signals available anywhere in global finance. Let me bring in a concept that I think is essential for understanding why China's gold exposure matters specifically for individual investors who are watching this right now. There is a fundamental difference between the price of something and the value of something, and understanding that difference is the cornerstone of every great investment decision ever made. Benjamin Graham, who taught Warren Buffett everything he knew about the relationship between price and value, described it as the single most important concept in all of investment analysis. Price is what you pay on a given day, driven by the collective mood, the current news cycle, the short-term behavior of every market participant. Value is the underlying fundamental worth, driven by the actual supply, the actual demand, the actual utility and scarcity of the thing being evaluated. China's gold accumulation is a massive, documented, ongoing signal that the value of gold, the strategic, monetary, reserve asset value as assessed by one of the world's most analytically resourced sovereign institutions, is significantly higher than the price that any individual can purchase it for today. This is the gap that Graham spent his entire career teaching investors to identify and act on. Not the gap between hope and reality, but the gap between documented institutional behavior at scale and the current market price that has not yet fully reflected what that behavior reveals about fundamental value. Now let me give you the practical framework for what this means for your own financial decisions, because insight without a clear path to action is simply interesting content that changes nothing about your actual situation. The first action is to establish or deepen your physical gold position, understanding that you're not simply buying a commodity, you are buying the same strategic reserve asset that the largest sovereign institutions on Earth have been accumulating at historically unprecedented rates, at a price their own documented purchasing behavior suggests is still below fundamental monetary worth. That framing changes how you hold it. Not as a speculative bet, but as a strategic position that the most powerful players in global monetary management are actively validating through their actions. The second action is to think about gold as part of a balanced, resilient financial foundation rather than a standalone position. The investors who have built the most durable multi-generational wealth have consistently maintained meaningful allocations to real assets whose value does not depend on any single government's continued credibility. China's accumulation is a reminder that this is not a fringe approach. It is the approach of sovereign wealth management at the highest institutional level. The third action is to pay less attention to daily price movement and more attention to structural signals, central bank purchasing data, reserve composition trends, documented behavior of the world's largest institutional players. These tell you far more about gold's trajectory than any short-term chart. China has been following the structural signal for 2 decades. That is the discipline worth emulating. The fourth action is to view every period of price weakness as the opportunity that patient accumulation always creates. The chance to add to a position at prices below what the structural evidence says the asset is worth. China did not stop buying gold when the price dipped. It bought more. Here is the complete picture, delivered with the honesty and the calm that a moment like this deserves. China's gold strategy does not tell you what price gold will reach by any specific date. No analysis can tell you that with genuine certainty, and anyone who claims otherwise is selling something that does not exist. What China's strategy does tell you, through years of documented, verifiable, large-scale purchasing behavior, is that the world's most patient and most resource-rich sovereign accumulator has assessed the real price of gold and concluded that it is significantly higher than what the paper markets are currently quoting. That is not hype. That is the most powerful form of fundamental validation available in any market. Validation through behavior rather than through words. Warren Buffett said that the best time to buy an asset is when sophisticated. Patient capital has already told you through its actions that the price is wrong. China's gold accumulation, sustained across years and documented in the World Gold Council's quarterly reports, is exactly that signal, delivered at the scale of a sovereign institution, pointing in the direction that every individual investor who has been paying attention already knows is the right one. The real price of gold is being exposed not with words, but with decades of documented purchasing behavior from the most strategic accumulator in the world. Position yourself accordingly. Hold with patience. Build with conviction, grounded in the most powerful signal available. And let the gap between today's price and the fundamental value that behavior reveals close in the direction it has always eventually closed throughout the history of patient, disciplined, long-horizon investing. If this gave you the framework to see China's gold strategy not as a foreign policy story, but as the most important investment signal in the current market, like this video, share it with someone who deserves to understand what the world's most strategic accumulator is telling them through its actions, and subscribe with the notification bell on for the next update in this series. Leave a comment with whether China's documented gold accumulation changes how you think about your own gold and silver holdings. I read everyone. Stay informed, stay patient. Position for the real price.